Buddy, it's Ed, and the future is now, and the future is the past stock market rise and falls, the present market fall that we're in, and the future of when we're coming out of it and where it's going to go. Okay. And I wanted to bring the data behind this. Okay. This is the Dow. I always track the Dow. You can track S&P, whatever, but I track the Dow and I do my percentages off the Dow. You can see this chart to show you. This is the whole Dow, but I'm starting in the past, 2003. You can see this green arrow where it runs up for 5 years to 2008. And then let me zoom it in to the top so you guys can see what we're looking at here. Okay. So this formation at the top is called a head and shoulders pattern. Okay. If you don't know what head and shoulders pattern is, look it up, Google it, and you'll see it. And it's virtually identical to this scenario. What happens, you have a big broad shoulder on the left. You have your head in the middle, of course, and then you have your kind of collapsed shoulder on the right. And then it feeds down. Okay. When I was trading Apple, I saw this and I got out. Right where the circle is, you can see the red circle is, because I knew that it broke the 200-day moving average, which was huge. When the market breaks the 200, that could be essentially the most important indicator. If it breaks the 200, that's a severe sign. That's not a positive thing. If it breaks up, that's a great sign. But if it breaks down, that is a horrible sign. So it broke down, and then it broke the head and shoulders down. And you can see what happened. It kicked down. And then it formulated the first bear flag. Means it pops up. People didn't really know what was going on. They're like, well, the companies seem okay. Everything seems fine. And there was like, well, why are some of the numbers bad? And it turned it. And then we started getting some bad numbers in. Okay. And around May, June, July, and it killed the flag. Okay. The bear flag broke and went down. Went into another bear flag going, you know what? Things sold off. They sold off pretty heavy. Everything's getting cheap again. So it goes into another bear flag. Okay, and this was September. Then we get around September, September, late September earnings reports, and all of a sudden the earnings on company after company after company was bad. Okay, let me zoom in on that a little closer so you can see what was going on there and that drop. That's where we get a huge hammer down, and it's a big sign there. Okay, and then we get a relief rally. This is where we started getting stimulus, like the Fed cuts rates and they try to fix the problem. Okay, so you get these bounces. Okay, these are not the bottoms. These are bounces. These are relief rallies. Right now, we are currently in a relief rally. We're not at the bottom. We're not in the beginning of this anymore. We're in a relief rally. Okay, they are giving relief. They even call it a relief package. Not even a stimulus package. This is a relief rally that we're in now. But this is the relief rally from back in 2008, okay, in about October. And then it doesn't hold. The relief doesn't hold. There's more pain to come. Okay, so you can see that down arrow, and then it goes into another bear flag, the third bear flag. Okay, and then it sells off after that and sells all the way down to 6,500. Okay, that was 50%, or a little bit more than 50%. It might have been around 55% from the high. Okay, so that is huge, 55%. Right now, we are currently at about 30, I think 30 or 30, right around 30%, I believe. 25 to 35%. Just depends on the day we're talking about. So anyway, now you can see that. Now we can see the V bottom. Okay? It would be hard to predict it when you're here. When it was collapsing from here, people thought that the banks were going to, a lot of banks did get shut down, but they thought, people really at this stage thought they were going to lose everything. Okay. And then we see this massive uptick of green after green after green after green after green, green, one red, green, green. I mean, massive V bottom here. Okay. And then it still goes up. It still has a good upswing from here. Now, what happened after that? It went up. I'm going to stretch it out. It went up for 10 years straight. 10. With correction, 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 correction. A lot of corrections here. I mean, there's a lot of little small ones as well. But there's at least like 7 to 10 corrections. Almost one every year for sure. Okay, so let's move to the present a little bit. Actually, to the recent past. Market's flying up, flying up. Okay, and then 2015, we had a pretty big correction. Let's get into all the way up. You can see how many years and how much time this was. Okay, so we can see it in a 2018 correction, end of 2018 correction, and then it went up for almost the entire 2019. And then we get this global issue. Okay, and you can see the moving average here, these moving averages up here. Let me zoom in a little closer so you can really see this. This was almost invisible. There's no sign up here. This was an invisible top. There is no way for anybody to be like, oh my gosh, this is a head and shoulders, or this is a V top, or this is an invisible top. Okay, and I'm coining that right now because if we have a situation like this in the future, it might be another invisible top like this where basically nobody really saw it coming. But when I saw it crash about 1,000 points, I was like, that's not normal. In a bull market, we were running up and, you know, we'd have our down days and everything, but this was not a normal situation. Okay. And you can see that the pink vertical is where we ended up selling Tesla because I was like, this isn't normal. This is not a good sign. So on the cautious side, I erred on the side of caution rather than greed, figuring, oh, well, it might go back up. It's going to kick back up this week. Don't worry about it. You know, we'll get over. I mean, I was being on the safe side. So it wasn't like I was naysaying and figuring the market was really going to just completely collapse, but I was being safe. So on the safe side, getting out made more sense there. Okay. And then you can see all the bounces, all these dead cat bounces on the way down. And then we get this relief rally, which looks very familiar, right? That relief rally looks very similar to the relief rally back in 08, 09. Okay. So, and right now we're down from 29,000, let's say 30 to keep it a round number, down to 20, okay, would be 33%, right? So right now, we're about 30%, 27% down. So to me, this is a relief rally, not a bottom of a potential 50% drop. We would have to be, in my estimation, down for it to be a full, complete bear market. We would have to be down to 15,000 on the Dow. Right now, we're at 21,000. So you're going to see a lot of whiplashing in the next couple weeks and months. We haven't even gotten into the earnings for Q1. The earnings from Q1 are probably going to be a bright side, even for Tesla and other companies, because that's backwards. We're not looking at, most of that is not, is not due to the global issue, okay? So you have to think about it this way. That's going to be a little deceptive. The Q1 earnings, everyone's like, wow, the company didn't do bad. This company didn't do bad. Yeah, most companies didn't do bad in Q1 necessarily. Aren't going to do terrible because it was toward the end of Q1 when this happened. Well, maybe not the end, toward the middle to the end. So you will see guidance go down. People will guide like, you know, but that would be expected. People are going to, you know, companies are going to say, hey, we're not going to have good numbers because of this happened and we had to shut these stores down, blah, blah, blah. So this is kind of baked in. So we're going to see another kind of relief rally or rally, you know, after Q1 earnings, I think, unless companies just guide to nothingness, you know. So it's the Q2 earnings that's going to put us in a world of pain because all these companies are just not making any money and they're having to cut employees, they're having to shut down stores. So we don't see, but this is the future that I see. This is why I think this is a relief rally and not a V bottom. And I've been trading it, just like I've been trading this entire down cycle to be safe. I am basically out by the end of the day, every day. I don't care if it gaps up or gaps down. The odds of it gapping down over the last month were a lot higher. So I would rather avoid the gap down and just play the trade during the day where it's safer and I can set my stops really tight, get in and out really quickly, and not be in some panic mode that I start the day down $4,000 and now I'm chasing it, revenge trading it, whatever you want to call, to try to get back the money. So I would rather, I missed the gaps up on the last 2 days and I'm fine with that. Okay. But I also missed all the gaps down from the circle, the red circle up top, all the way to the bottom. I had 0 gaps down. And if I was gapping down, I was shorting something. So I missed that, and that's more important than getting greedy and thinking, okay, we're low, we're good shape right now. We haven't even gotten to Q1 earnings. That starts April. Remember, January, February, March. April would be Q1 earnings. And then we got April, May, June, July, Q2 earnings. That's when I can see a lot of downfall. We could move sideways potentially or sideways down slightly for the next month or so and then really get, kicked at that point once the Q2 earnings come out, which is going to be brutal on pretty much all companies, or any company that's exposed to this. So also, remember we looked back at the moving average, okay? Let me expand it here. You can see the 200, which is huge, okay? It actually kicked the 50 and went down. It kicked the 200 and basically went straight down. This is why I said that 200 is very important. So seeing that kick off at 200 and going backwards is a horrible sign. That's almost a sign every time that the market's going way lower, and sure enough, it went way lower from there. So anyway, the 200 moving average, for me to be in buying mode, I'm not going to have to be above the 200-day moving average, but I want to be approaching it. Right now, we're not even close to the 20-day, much less the 50-day or the 200-day. Let's go back again. Let's rewind. Let's go back to 2008 and see when the good buying spot, 2009. Let's zoom in on it and see how tight we can get on this. Okay. Now, let's see. Where's that 200-day? Holy cow. Look at the turn of the 200 and look at what happened. It was gone. When it crosses the 200 going north, that is buy, buy, buy. That is the moment to be in for sure going long. But still, I would rather get in when it crosses. You see the 50-day down where that red circle is. That's more or less where I would rather be loading in long, okay, is towards the 50-day. Because I like playing a little tighter because I'm following the markets every day. So I don't mind crossing the 50. Or I'm sorry, the 50. I think that's the 50. Hang on a minute. Let me double check. Yeah, that's the 50. The mid blue, okay, where the red circle is. So across the 20 going up, but that doesn't necessarily mean a lot. It crossed the 20 a bunch of times going down, but it crossed the 20, crossed the 50, the 200-day moving average is total reinforcement. It crosses that and it's gone for 10 years basically. I mean, yes, it crossed it back and forth a few times, but that was the big sign. We're not even near that situation now. So go back to present. You can see where, actually, let's go back here. Where's that relief rally? Right about here. And we're way far away from those moving averages. Okay? especially the 50 and 200. Their relief rally, so you can see that back there. So this is why I see it being, this is the first of potentially many relief rallies. But let's zoom back in on this. Let's see what we're up to. So now let's start adding some data. Like I'm going to add some time. Okay. So what I'm seeing is that you can see the green arrow going up. You know, obviously the downside, the green arrow going up for our first relief rally. But what are they going to do? What's all the news after that? Remember, in the bear market, the news drives a lot of the data. Okay, it's not like company evaluations or the company earnings or anything. We don't even have the earnings yet. So it's not like the companies are driving the data. The markets are pulling the companies down. In a bull market, the companies drive the market. Okay, in a bear market, the market pulls down the companies. Those are basically the differences. So you got to understand it's a different market. This bear market, it pulls the companies down. So if one sector, if one company, let's say an oil company does bad and kills the earnings, all the other oil companies get pulled down too. It doesn't matter that they didn't report bad earnings, but they're going to get pulled down just because that other oil company got pulled down, meaning that all the oil companies are probably going to do the same thing. So, and you could say that with any sector, retail or whatever, tech stocks. Oh my gosh, Google reported awful earnings. You don't think that's going to drive Tesla stock down? Absolutely. So, in other companies that are in tech areas are going to drive other tech companies. I mean, granted, I look at Tesla as a tech company, but instead of automotive. But you can see even automotive. Let's say Ford or GM get knocked down. That will pull Tesla down, you know, potentially. So, anyway, meaning let's say global auto sales start going down. So basically, I see this with, you know, this is a relief rally. We've got more pain. I would be super cautious if I'm doing anything long term, or I would be nibbling in if I wanted to buy long. I would expect to be losing money over the next couple months with those longs, and I would load up gradually as I'm going down, or I mean bite size as you're going down. I don't like buying going down. I like buying going on the uptrends. We're not even close to those moving averages. The 200-day is miles away. It's 27,000. Okay, that's huge. Right now we're at 21.2. Okay, it's 6,000 points away from crossing that and being positive. So this is not a good sign. Okay, it means we have more pain. So if anybody thinks that this is some sort of V bottom, they're crazy. It's not. Okay, this is absolutely a relief rally based on the $2 trillion stimulus package. Okay, so that's what I see. I wanted to give you guys that update so you weren't like feeling like you had to rush in, like, oh my gosh, I'm missing out on Tesla or whatever. You know, I even have that. I've had that FOMO in the last couple of days, like, oh man, should I have been buying? Should I have bought down at that 380 for a permanent long? But when I do the technicals, when I analyze it versus the, granted, this is a different situation than 2008, but it's a bear market versus a bear market. I'm comparing two bear markets and comparing two similar activities, relief rally versus relief rally, you know, bear flags versus bear flags, etc. So anyway, I wanted to wrap it up. I hope you guys like this, and I hope that makes you understand to be patient. It's important to be patient, okay? I'm not saying that this isn't necessarily a good time to buy, because remember, we sold off so quickly. Okay, but that doesn't mean we're not going to get some pain in the next couple months. I mean, if you guys think that Q2 earnings reports are going to be spectacular for the country, rethink it. It's not. Okay, and this is kind of what happened in '08, where everything started pulling down. The market started pulling down all kinds of sectors. And I was like, man, why was Apple getting pulled down? They didn't do anything wrong. That company was on fire. But it didn't matter. The market pulls down the companies in a bear market, not the other way around. The companies don't pull the market up like in a bull market. Every time companies blast their earnings and beat it, that pulls the entire market up. Now we have it in reverse. The markets pull down the companies. So anyway, I'm going to wrap it up with that. And I hope you guys like that video. And be sure to subscribe and like and share it with anybody. And just be patient out there. And you've got to pick your moments and let kind of the market come to you a little bit. You don't need to rush in it. You need to evaluate it. And these technicals just don't lie. The numbers tell the truth on what's happening. So it doesn't mean there's not room to make money. Like today, we had a good trading day. We made like 3,000 on Tesla, just trading it. And I missed the gap up, but I was basically watching it like a hawk and monitoring it, and I was on top of it. And I missed the sell-off during the last 20 minutes of the day. So it was like, wow, I almost bought there thinking, okay, it might gap up. But then I was like, okay, don't break your own rules, forget the gaps. So I was like, forget the gaps. If it gaps up $50 a share, so be it. I'm going to let it gap where it does. But what I don't want to do is start the next day down $2, $3, $4, $5,000, and then mentally feel and emotionally feel like I have to chase it. Oh man, I just lost 3,000. Now I got to chase after that 3,000. That's when you really start making mistakes. So be careful no matter what you're doing, whether you're long-term investing, short-term investing, day trading, whatever it is. Be careful out there. That's my opinion. All right. Anyway, I will talk to you guys on Thursday. Have a great rest of your Wednesday. Talk to you later.